You're listening to certified financial planner Doug Goldstein, host of the Goldstein on Gelt Show, www.goldsteinongelt.com.
Okay, I'm very excited to have on the Goldstein on Gelt Show David Rosenberg, who is the chief economist and strategist for Gluskin Sheff and Associates. They're based in Canada. They deal with investment portfolios for investors, professionals, family trusts. And as David is an economist, he is probably someone who is in a great position to begin to talk to us about designing a portfolio that makes sense given what seems to be a rather turbulent political environment. So, David, my first question to you is, do politics really matter for people who are long-term investors?
Well, I don't think that the politics are going to have a large influence if you have a certain time horizon that's, say, beyond, say, 3 or 5 years. They can produce wiggles along the way and short-term fluctuations. But ultimately, investors, and this is true whether you're investing in commodities or you're investing in currencies or in the bond or the stock market, you have to keep both eyes firmly on the economic fundamentals because they will virtually win out every single time if you have a long enough time horizon.
So what does that really mean? Because when people, for example, when the politicians speak, everyone says, oh my gosh, healthcare is going to collapse, or there's going to be war in the Far East, and these seem like fundamental changes, except for people who've been around long enough, we begin to realize that it begins to sound like a broken record because there's always something major. How do you distinguish what's really a fundamental change and what's just a lot of noise?
Well, firstly, I'll give you the best example that's on our minds right now is Trumponomics. And this whole notion after Donald Trump got elected, and of course, with one-party rule in the House and the Senate by the Republicans, that we were going to embark on this prolonged period, really new era of sustainable, accelerating economic growth and inflation. And that certainly was the narrative that started on November the 8th. And then, of course, we have the reality, which is that the economy is really not doing any better than it was when Barack Obama was president. And if anything, underlying inflation pressures are dissipating. There was this view, and I know people will say, well, but look at what the stock market's doing. The part of the stock market that's doing well are technology stocks, which are operating on their own set of dynamics. But that was the one part of the stock market that was supposed to do the worst under a Trump presidency because they are most hitched to global supply chains. And they were supposed to be broken down because of the xenophobia and isolationism and nationalism that was supposed to follow this Trump presidency. Well, that hasn't happened. I always say the truth is always in the bond market. And you have 10-year Treasury note yields now at 2.25%. So they are certainly not telling you that we're into some new sustainable growth and inflation phase. So people were starting to invest around the politics right after the U.S. election. What a mistake that ultimately proved to be. I was a skeptic to begin with because I did the research on it. And I was saying you can take the data all the way back to Ulysses Grant if you want, that even the most effective presidents barely get legislated half of what they campaigned on, whether you have one-party rule or not. So what half is it going to be that you want to invest around Donald Trump? And of course, we're seeing what's happening with healthcare. We're seeing what's ultimately going to be a non-event around tax reform. Of course, there's things he can do in terms of deregulation. That'll spin the dial a few basis points on economic growth. But nothing big ever happens in the United States unless you get 50 votes in the Senate. Full stop.
Well, yeah, let's go back a little bit and just sort of understand where someone can look to get a better understanding of what's truly going on. You said the truth is in the bond market. What does that really mean?
It means that, it's the most liquid part of the capital markets. Historically, you're taking a look at either coming out of recession, going into recession, or anywhere across the business cycle, the bond market's giving you a clue, and the shape of the yield curve is giving you a clue as to where exactly you are in the business cycle. Are inflationary pressures building? Is this a signpost to be big on growth, big on cyclical, or does it mean you should start to become a little more defensive? So I've always found that when people talk about the markets being a leading indicator for the economy, what actually ultimately leads the stock market, because that's what people believe, is that the stock market's leading indicator, but the bond market actually leads the stock market. So focusing on what bond yields are telling you, if bond yields, for example, the view was that bond yields are going to go up and stay up, and if that were indeed the case, you would have had a big reflationary trade going on that you could invest around, say, in markets globally and across the capital structure. But you see, that hasn't really happened. So the bond market, to me, is always the market you want to look at in terms of what it means as a forward-looking indicator across the different asset classes you want to invest in, and of course, what your view on the economy is going to be. Understandably, the stock market has done well. Not every single part of the stock market has done as well as others. But the bond market right now is telling you as an equity investor to tread very cautiously, that the bond market is telling you as an equity investor that the risk that we're going to be seeing, the earnings growth that's embedded in stock market valuation right now, the odds that we see that over the next 4 quarters is actually pretty low. That tells me that you want to be pretty conservative when it comes to equity investing. That's the message from the bond market right now.
We're talking with the chief economist and strategist of Gluskin Sheff and Associates in Canada, David Rosenberg. He's been talking to us about the bond market. David, I want to talk a little more tachlis, because a lot of people who are investing because they need income. And quite frankly, with a low interest rate environment, they're shocked that they can't get income to live on from their portfolio. And then they're hearing these rumors that the bond market's about to collapse, and so they don't know where to put their money. Because, as you said, if the bond market is leading and it collapses, well, it's certainly not a good sign for the stock market. What can normal people be doing who need income off their investments as opposed to looking for growth?
Okay, well, I'll make this comment strictly for the few people out there that truly are normal. We always tend to try to find out where the norm is. But look, I think that is actually the big challenge. We are in a classic deflationary phase where, coupled with demographics, excessive debt loads globally, means that interest rates are going to stay low for an extended period of time. This always happens, by the way, after an epic asset and credit collapse like we endured in 2007, 2008, 2009. We saw this in the 1830s, the 1870s, 1907 collapse, the 1930s. We're going to be in this period of challenging investment environment for an extended period of time when it comes to interest rates. Unfortunately, what's happening, of course, is that the baby boomers in the United States, the 78 million pig in a python, just turned 70 in the past year. So we have this demographic bulge right now that historically is craving income and recurring reliable cash flows to help fund their retirement. And so this is actually a very big challenge. And it's a great point. It's one reason why, despite the fact that I'm very cautious on the stock market, the parts of the stock market that I like are the parts that generate that income. For example, the Canadian banks. You could do a lot worse than invest in Canadian banks that will pay you a 4% yield, that pay you not just the yield, but also characteristically very strong dividend growth. That's a part of the market. I look at the financials in the United States, of course, much more regulated today than they were in the last cycle. That's probably a good thing. But now they're paying out dividends, their dividend yield's going up. So I find that actually, if you're going to be looking at parts of the capital structure, parts of the stock market that I like, it is dividend growth and dividend yield characteristics. And actually, the financials in North America, and for your listeners in Israel, insofar as you can capture that, the financials in North America are a very good place to be, that are a nice surrogate from investing in the bond market, where yields are obviously unacceptably low for a whole range of people out there.
So you don't feel if there's some sort of market collapse, the financials, like 10 years ago, are going to be the first ones to take it on the chin?
Very interesting, because, I was looking at, specifically in the U.S. today, I was looking at a bunch of charts, looking at deposit loan ratios, looking at delinquency rates, looking at Tier 1 and core capital asset ratios. And you know what? If there's a problem looming, invariably, when the Fed is raising interest rates, as they have been, you tend to get a financial accident. But these financial accidents, cycle to cycle, never happen in the same place. It's like lightning does not strike twice. And so the next bubble, wherever it bursts, and maybe it's in commercial real estate or maybe it's in subprime autos, it's not going to be in the residential mortgage market like it was in the last cycle. And it's probably not going to be in the U.S. commercial banking system. It'll be somewhere else. So when I take a look...
But you can't tell us where, can you?
Well, I just finished telling you that, I would be running screens on, if there's a few bubbles out there, there's bubbles obviously in these very whippy growth stocks, these FANG stocks that have a 70 multiple collectively and remind me of the Nifty 50 back in the 1970s. Commercial real estate looks bubbly to me. Subprime autos is an area that's problematic. And so there are areas out there. But you see, what I am saying is that these are not areas that are going to bring down the banking system. The banks in the United States have become regulated utilities. The difference is that the authorities are now letting them pay out dividends to shareholders. So you're taking a look at where you want to be situated in sectors that where you're going to be getting the owners of where you're going to be seeing the business operators returning capital to their shareholders over time. And I think that the financials today, the U.S. financials, regional banks, the large investment commercial banks, much safer place to be than they were obviously a decade ago. Maybe at any time since we had the stable period of the 1950s and 60s. The banks have become regulated utilities, which means that the growth of their balance sheet is going to be constrained. That much is true. But for aging but not aged baby boomers who are seeking income as a refuge from what you can no longer get on the government bond market like you used to, the bank stocks, and I take that in relation to the fact that you are taking on some capital risk. But I think that there's a very prudent place to be putting capital right now is in financials on both sides of the border in North America. The Canadian banks are rock solid, and plus you'd be investing in a currency, the Canadian dollar, that's entered into a new bull market, something that people on your show should be looking at right now.
All right, David, listen, this has really been fascinating. Unfortunately, we are just about out of time. So tell me in the last few seconds, how can people follow you and follow your work?
Okay, well, I produce a daily called Breakfast with Dave. I've been doing this daily market and economic commentary since 1998. If you want to email me directly, the best thing to do is to email me at drosenberg@gluskinchef.com. That's drosenberg@gluskinchef.com, or just go on the Gluskin Chef website. You can find me there.
All right, we will put a link to that at the show notes of today's show at goldsteinongelt.com. David Rosenberg, thanks so much for taking the time.
My pleasure. Lee Trott.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.